We're back. RealTalkTwinCities.com, Cheryl Kempenek, Coldwell Banker Burnet. I'm Eric Purius with Bell Mortgage. Every Sunday we're offering you all things real estate, local expert advice. We're here with Mark Foreman of Foreman & Earhart. He's a CPA and the managing partner of Foreman & Earhart. Been doing the tax thing for 30 years, isn't that right, Mark?
That's right. I've been in private practice for over 30 years. Seems like it was yesterday. Early 1980s, things were a lot different, but it's been a good ride. And
Sure. So you're local then? You're in Bloomington?
that's right.
Okay, all right. And a lot of, how many folks in your firm, roughly?
We have 10 people
Okay.
in our office.
And you mostly, do you have an area of, that you specialize in, or?
Well, we consider ourselves a generalist firm. Where
Okay.
we don't particularly specialize in one area. There are some areas that we don't feel particularly experts in, so we avoid those types
Sure.
of things. But mostly small businesses, individuals.
Yeah, you mentioned entrepreneurs, you're my accountant. I think we should.
Which is really a good point, because that's what we're doing here today, is we are offering local expert advice.
Right.
And so Mark Foreman here from Foreman & Earhart is nice enough to come in. And so Eric, you
Yep.
are Mark's client. And
Yep.
we love to connect with our clients and the people in our
Yep.
own spheres. So we're happy to have you here. And we know that you are a specialist, not only being a CPA, but also in financial planning. And so one question that I have for you is, how has your business changed with technology? Now we've got, TurboTax and H&R Block and all these software accounting packages. How has that impacted your business?
Yeah, it really has had a dramatic effect. Back in the mid-'80s, you can about imagine it was a lot of data entry, a lot of pushing of paper, and not a lot of one-on-one contact with the client. With the technology improvements, it has enabled us to remove ourselves from that compliance and paper pushing role to more of a consultant and advisor to our clients.
Yeah, I remember the days of keeping all of our little paper receipts and throwing them into a box and handing them over to the accountant. Does that still happen?
It does.
Oh
it
my
does.
gosh.
But it quickly changes from that point. We use scanners a lot, and so the documents are scanned. If the client doesn't scan it, then we scan it in, and you get that electronic version of the documents, which can be maintained forever.
Yeah, that makes it so much easier to store your taxes.
That's right.
One thing I remember years ago when I got audited, they wanted to see every single little receipt. Does the IRS still require that, or can you just hand over like a bank statement now that shows what your spending was?
Whenever you have an audit, that you have to prove evidence of your, the numbers that you put on your tax return.
Mm-hmm.
And that evidence can be many different,
So a statement might be allowed today.
That's right. That's
Okay.
right. And it's left up to the auditor to determine what is substantial evidence.
Is there any benefit to bringing just the first time you come in to sit down with the auditor, just have 10 boxes of stuff, and just so they might get overwhelmed and say, yeah, all right. I mean, does that happen, or will they go ahead and go through it all?
Well, these people are reasonable, and they're well trained in their jobs, and believe me, they can smell a rat when they.
Are you insinuating that Eric is a rat?
No, not at all. But when you're faced with a situation where you're being audited, I think being honest and upfront and give the documents that are being requested, and it's not a confessional. You don't have to start confessing anything, but whatever is asked of you,
Sure.
you should deliver.
It makes sense.
And so one of the important things, obviously, now we're getting close to the end of the year, is tax planning. And we talked about this a little bit before we came on the air, but one thing I wanted to bring up before we get into that conversation is the mortgage debt forgiveness tax relief. This is something that we have seen quite a bit in real estate. And basically, it's a tax on phantom income. Most people have heard of short sales when it comes to real estate. And the rationale behind doing a short sale is then a seller doesn't have a foreclosure on their record, which helps them in the future by doing the short sale. But if they owe, let's say, $200,000 and the bank agrees to sell it for $150,000, then we have
Right.
this $50,000 gap, which the mortgage company sends out a 1099 to that homeowner, and then they have to add that to their income and pay taxes on it. And so up until the end of 2013, there was tax relief, and that expired. And so now this year, unless there's some legislation to extend that, all of those homeowners that did the short sales will get hit with that 1099 and that tax increase.
Yeah, there are a number of tax, temporary tax components of the code that have expired, and we are watching Congress very carefully to determine, and we believe that most of them are going to be extended, because that is the kind of thing that does have bipartisan support and the support of the president, is these types of obviously things that would hurt average taxpayers, you know, if they don't extend. So
Right.
we believe that that will happen sometime after the first of the year.
So that's something we're all gonna watch pretty closely because it does impact our clients.
And I'm sure that the National Association of Realtors, the lobbyist groups are probably right in there with the legislatures
Yeah.
fighting for this. Because can you imagine being a homeowner if you didn't understand that and you agreed to a short sale rather than the foreclosure, and then you would get hit with that? That would be a pretty big surprise.
So whatever the difference is you count it as income. So say could easily be $50,000, $60,000, $70,000 of income, right?
Right?
Wow.
Yeah. And that could be a lot. I mean, even if you're in the 25% tax bracket,
Mm-hmm.
that's a big check to write at the end of the year.
I had a big check to write at the end of this year, which led me to believe that selling my single family last year might not have been too good of an idea. At the time, I thought it was a good idea. The market timing seemed right. The values were up, and I had a renter leaving, and when it came tax time, however, I paid quite a bit of capital gains, and I went to Mark and I said, Mark, did I screw up? I didn't talk to you guys before I did this. And Mark actually said no. I don't know if you remember that conversation.
I do.
Yeah, and so share with us how I didn't screw up.
Well, what's interesting about the investment real estate
Yep.
market is the idea that prior to 1986 you could have losses. If you have gains, there's really not an issue. It flows through to the front of your personal return, and you pay income taxes on your earnings
Mm-hmm.
from where the rental income is higher than your expenses. That's not an issue. The issue comes in when you have losses. So what to do with these losses? In the old days, you would take those losses and offset it against your other income, W-2 income, other business income, but that all changed.
Mhm.
Now, for most taxpayers, those losses are suspended. You don't get to deduct them in the year that you have them. They're not lost, they just sit there and they get freed up under other circumstances. The other circumstances are that these rental properties generate profits in the future, and then those profits offset these suspended losses. Or, in the case where you sell the property, those losses are freed up. Even if there's a loss on the sale of the property, it frees up those losses at that point.
Gotcha. So as far as timing goes, because if you're an investor and you're thinking, wow, should I sell these? Values are up. Should I list these? Should I list a couple of my rentals? I don't owe that much on them. I could get $100,000, but maybe I should wait till next year. So what you're saying is that the timing of selling an investment property should have to do with what I think. In other words, do I think the time's right? Is it right for me personally, rather than an imagined, perhaps, tax consequence?
That's right. When I counsel people in tax planning and trying to make decisions, I've come to the belief system that you do not let tax ramifications dictate your decisions, your economic decisions. So what that means is you should be aware of your tax ramifications are of a decision, but don't let that be the driving force of your decisions. Because if you're talking about taxes, it's really just money. There are greater taxes where is not making a decision could have. So if you see a bubble in a particular real estate market, take advantage of an extra $5,000 or $10,000. That's a much greater tax than potentially a tax liability.
Right.
Now there are extenuating circumstances where you could have some large losses that could be freed up. You know, you can't ignore that. You just need to be aware of it.
And so one of the things that we talk about with investment property is cash flow. And we really want to have a positive cash flow and not negative cash flow. So Eric, you weren't in a situation where it was negative cash flow.
No.
You had a property that you knew you had a considerable gain on.
Right.
You were able to sell it for much more than what you paid for it,
Yep.
even after the improvements. And you were really just tired of being a landlord in that particular neighborhood
Yep.
with some of the crime issues that were going on. Mark, when we come back, one thing I would like to ask you is about cash flow and what your recommendation is for what is a good amount of cash flow. So maybe you can think about that. If somebody is thinking about doing investment property, would that mean, you know, $100 a month positive, $300 a month, something like that? And we are Real Talk Twin Cities. I'm Cheryl Kempenek with Coldwell Banker Burnet, along with Eric Pirius of Bell Mortgage, and we're talking with Mark Foreman of Foreman Earhart. And when we come back, we're going to continue talking about year-end tax planning and some financial advice. And then we will get to our topic of what is the most affordable city in the U.S.